And what I mean by peaks and troughs is, remember I had my short-term up and down trends earlier. A short-term uptrend could be identified by consecutive days of, higher highs and higher lows. So there's a short-term uptrend in place. And then we have a short-term downtrend here, and between the short-term uptrend and the downtrend we have the highest point, which is a peak. Perhaps I'll just depict that as a different colour. We have the peak, we have a peak back here, and the low points between the short-term downtrends and ups are troughs. Just a very simple way, and then we have higher peaks, higher troughs. Guess what? We have a medium-term uptrend. It doesn't have to be any more complicated than that in identifying short-term and medium-term uptrends and downtrends. Very simple way of identifying trends. And of course the other way is to draw that moving average, and we'll just get some line which just comes over the chart and gives us a general direction, overview of the price of that particular stock. Gives us a general direction, right, the trend. And one of the common things when people talk about trends is they talk along the lines of a trend is said to exist until there is absolute evidence that it no longer exists. Right? So we maintain the fact that there is a trend in place until there is absolute evidence that it no longer exists. And of course, whenever we get a reversal signal and we get lower peaks and lower troughs, guess what? That's absolute evidence that this medium-term uptrend no longer exists. And if that's what we base our entry decision on, we have all the reasons in the world to say, look, the reasons why we got into this trade in the first place don't exist anymore. Why are we still in the trade? Right? So it's just a very simple way of perhaps exiting a trade. Now, I don't talk about this anywhere else, but a very simple rule that I've come up with technical analysis is I call it my rule of V. My rule of V, and I'd just like to, this will take 60 seconds or less to explain, and I think it's a very powerful concept. Some of you will look at it and say, well, that makes a lot of sense, I've seen that before, but I'm amazed how many people fight the rule of V and do things the wrong way anyway. Here's my rule of V. It suggests how many times have we seen a stock price rise quickly over time. This may be several months, let's call it 3 to 6 months, and then just as quickly, if not quicker, we see it fall all the way back down again. We see this so often. However, what we don't see as often, and this is now a separate chart, what we don't see as often is a price falling like this, and let's call it a 3 to 6 month period, and then just going straight back up again. You see this all the time. You rarely see this. Rarely, almost to the point of saying it doesn't happen. This is my rule of V. It suggests that this happens all the time and this just doesn't. So what that means is when we are at some point along the chart here and we think this is a wonderful buying opportunity, this violates to me really two rules. Number one, you're not following the trend, but if you happen to just pick that one day, as Hugh mentioned earlier, he was the bullish of all bulls on that particular stock. Maybe you're the bear of all bears and you pick the lowest point in that stock for the year. So just by chance you do that, the last thing this stock is going to do is just reverse and go straight back up again for the next 6 months. It just doesn't happen. What does happen is when it does reach that low point, on the day of course we buy, hopefully, it then goes through a process or a period of consolidation. There are just so many charts, so many examples of an extended fall in price and then just a sideways movement for some period of time. So even if you happen to pick it on that day when it went no lower, why would you want your money in there for 6 months anyway, doing nothing? That's why I like the idea of following the trend. I want to buy things that are going up. I want to buy things that are going up. It almost goes against our natural feelings when we enter the market. We don't want to buy things that are expensive, that are too high. We want to buy things when they're cheap. No, not at all. I love buying things when they're high. I love it. And over the last 4 years, with the way equity markets have been performing, they've just kept on getting higher. Right, so I actually love buying things when they're high. I love following the trend and I never think to myself, I've got in too late. There's just no way this could keep on going higher from this. I never think that to myself. Never, because things can always go higher. And as I said, with the strength of equity markets, over recent times, things have done that and they've exceeded everyone's expectations. So never think prices can't go any higher, because they often do. Dave?
Just wanted to again build on something. While you're sitting there, just to think about where this fits into the overall framework of designing a profitable trading system. At the moment we're focusing in on entry, so we're talking about some underlying conditions that you would expect or would like a particular instrument to exhibit before you would consider trading that. So we're going to go through a few of those, trend being one of the most important and the first ones. So regardless of what method or way you come up with, and we'll talk about some examples a little bit later, but no matter what method you choose for identifying the trend, it's a good idea to have something in your trading system for the entry component that consults trend. And then think about that for each different component we go through.